if you buy one product in one place, that's not being diversified. I like multifamily as a diversification strategy because if you have a single family home and you're renting it and it's empty, you're not getting any income from it. That is the riskiest you could be.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling your business and compounding your wealth starts every day with the mindset of stewardship over ownership and applying billionaire principles. Our ultimate goal: to help you scale and compound your wealth so you can give more or all of it away for maximum impact. I'm your host today, Brett Swartz, and each and every episode we feature some of the world's top entrepreneurs, millionaires, and billionaires. They share their principles, values, secrets, and wisdom, providing each of us with the insights we need to reach the next level of success and impact. I'm excited about our next guest. He's out of the Knoxville, Tennessee area, and he has a really cool background in IT for over 30 plus years, managing small and large scale, high budget IT projects as a consultant for government and private projects, specializing in network design and security across the nation. He started his own IT consulting company back in 2004 and another in 2006. But he also has a unique real estate background as well. When he purchased his first single family home in 2003, he grew his portfolio with addition of more single family rentals, a trailer park, multiple commercial properties, including warehousing, office buildings, and storage, and so much more. And he is a part of Empire Builder Capital.com, where you can learn more about what they're doing. Please welcome to the show with me, Sean Thompson. Sean, how are we doing?
Good, sir. Thank you, Brett, for having me on. I really appreciate it, sir.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, so I started my own IT company and decided that IT wasn't going to get me the freedom that I wanted in life. So I started learning about real estate investing. I grew up. My parents didn't have a lot of financial education, so I got myself around people that had money and learned how to handle money from those folks. And so I grew up. I didn't have a lot. We weren't poor, but we were lower middle class, and so started doing stuff with real estate. I actually went through a divorce in 2008 and was kind of upside down. I owed more than what I was worth, and started buying single family houses and build up to the point where I had close to 40 single family houses, and realized that 40 single family houses don't really provide a lot of cash flow. And I had a lot of paper worth, but I didn't have a lot of cash flow, and they were running me ragged. The farthest ones apart from one another, it took me an hour to drive from the two extremes. And I just realized that there had to be something better. And I found out about about how single family properties were valued versus multifamily, and why multifamily could be a better vehicle to get me to the freedom that I wanted.
Excellent. By the way, thank you so much for that. We're talking about pillars of a diversified real estate portfolio. I also like that your background went from the single family into commercial properties. First transaction, $5.8 million warehouse, and then you began to you flipped a bunch of houses and renovated apartment
Yeah.
complexes, and sold over 100 properties. And so you have the tremendous background, and now you're moving that with Empire Capital, where you guys are buying multifamily and scaling that way, which we'll be talking about. But let's dive right into the topic at hand, which is really the pillars of a diversified real estate portfolio. So, in your mind, Sean, what would you say is the number one secret to having a diversified real estate portfolio?
Well, if you buy one product in one place, that's not being diversified. I like multifamily as a diversification strategy because if you have a single family home and you're renting it and it's empty, you're not getting any income from it. That is the riskiest you could be. Whereas if you have multiple apartments in a single location, you can afford to have one of those units empty and still be able to make your mortgage payment and continue to get some income from it. So that's one of the ways that you can be protected through purchasing multifamily.
I could agree with you more, right? So diversification on just multiple units, right? That makes sense. And then two, multiple locations is another way you can diversify.
Yeah.
And number three, I do like that multifamily is your guys' specialty, because we're not saying not to specialize. We're not necessarily saying, be an operator of 5 different product types. It's specialized, but get more units and then multiple locations. By the way, to that point, the importance of this diversification in times like this, right? We're talking about what the market feels and looks like today. What's your thoughts on what that feels and looks like today, and the importance of diversification in a market like this?
Yeah, so we can all feel it. We can feel there's something going on out there. We know that there's a storm brewing. And we've seen areas like in parts of Florida and some other places where we're starting to see single family home values go down. And the problem with single family home investing is those properties are basically valued at the extremes. Whatever your property is worth today is basically what your neighbor sold their house for down the street yesterday. So if your neighbor was able to sell their house really, really high, your house is worth more per square foot than what it was before. And we've experienced this huge increase in a short period of time, basically, higher than most of historical numbers. So we've seen this huge increase in the price of real estate. I think we're going to see some neighborhoods are going to see a correction on that. So I've gotten burnt before on houses that we flipped. We build up this. Our goal was to buy houses and force appreciation by buying the worst house in the neighborhood and fixing it up. And I did that with a lot of properties. Well, we got stung on one time. A partner and I did, where we lost money on a house because we fixed it up, and the guy down the street lost his house, and it went to HUD auction, and it basically killed the values of the houses in that neighborhood. And one of the cool things is when you get above 5 units, five apartment units, you are getting into commercial real estate. Commercial real estate is valued completely different than residential. Residential is all based on comparables. Everything in multifamily or commercial real estate is based on income. So they have a formula that they apply to the income, and the value is the value. There's this thing in there called the cap rate. The cap rate can change, and it can have an impact on the value of the property. But cap rates historically don't change very quickly or a ton. So I can predict 3 or 4 years from now about what a multifamily property is going to be worth, but I can't do that with residential. Residential can have these wild values that go up and down, and that's one of the things that we can't. When you buy real estate, you make your money on the buy, and you can only control what's going on when you buy. The sooner you buy, the better. We can't always control what's going to happen when we go to exit, and I like to be able to predict what my property is going to be worth on the exit than 5 years from now, based upon what I see rents doing and the income that's coming, rather than what can happen in a residential market.
Got it. Yeah. By the way, we're speaking with Sean Thompson, and you can learn more about him by going to buildercapital.com. That's empirebuildercapital.com. So your unique background, right, and skill set, Sean, coming into, you've done real estate, IT, kind of technical, right? And I like how you're breaking it down. Like, you got to be really clear about what you're buying and basing the values upon what, whether it be comps or income for commercial real estate, understanding the differences there, and that helps you to have a diversified portfolio. When it comes to multifamily, what are you seeing right now? What are you excited about? What are you cautious about? And anything that's like a live deal that makes a lot of sense.
Well, right now we're seeing a shift in our market that there's a lot of people who bought deals back several years ago when interest rates were really, really low. And one of the big differences that you got to understand between commercial and residential real estate is commercial is the short-term loans. Usually you can negotiate anywhere from 2 to 10-year loans. And the shorter the term, usually the better the interest rate. Whereas you can go buy a single family home, that those mortgages are supplemented or backed up by government, Fannie and Freddie, and you can get a 30-year mortgage on an investment single family home. Well, what's happened in the commercial real estate right now is a lot of those loans are coming up for renewal, and the interest rate, 3 years ago was half of where it's at now, or maybe even a little lower. And those deals are suffering right now. So there's some people that had investments that they aren't doing really well because the person or the group that purchased those, they were not conservative when it came to doing the financing. Where as an IT guy, I am very, very conservative. We always look for what could happen. So we're really, really conservative. I like to lock in long-term rates on property. So basically, if something happens and there's a storm that comes and the property value goes down, as long as you're cash flowing, you don't care. You don't care if you're single. If you bought a single family home 3 or 4 years ago and it's renting and you're getting cash flow, you don't care if it goes down in value. If you got an apartment complex and something happens in an area and it goes down a little bit, as long as it's cash flowing, you don't care. But these people had loans that are coming due where the payments are going to shift up to where they're not going to be able to afford to continue making those payments, and those properties are going to sell. That's one of the exciting things in our market right now, is that you're going to be able to pick up some really good properties in some really nice markets, and we are very conservative in our underwriting to make sure that the people that we work with can get the best deals, because our
Yep.
goal is to help other people achieve their financial freedom.
Good. Yeah, I like that, Sean. Yeah, I call it negative arbitrage, right? Where the cap
Yes,
rates are at, let's say a 5 or a 6. Hopefully they're going to get to 7 or an 8, but the interest rates are at 6, 7, 8. And so that negative arbitrage, where it used to be the reverse, used to be cap rates, let's say at 5 or a 6, maybe even a 4, depending on what you're buying. But the interest rates were 3, 3.5, 4%. And so this whole dynamic has shifted. We call this trying to navigate cash flow, tax flow, and debt flow. Sean, I want you to think about this for a second. We believe that's the three-dimensional way of investing in real estate. Most investors or operators, they operate in a two-dimensional world, meaning it's a cash flow, it's some tax flow, but oftentimes we've taken debt flow for granted. Or they don't know how to, they know about the 3D of it, but they don't know how to navigate without getting crushed by capital gains tax, right? Like, for example, the 1031 exchange, you have this cash flow going, right? And if I bought it at a 4.5 cap and I borrowed at 3%, maybe I increased it to the cap rates have gone up to 5.5, maybe 6%. Well, even if I sell it at a gain, I'm taking on debt potentially at 6, 7, 8%, right? And so now
that's right.
my arbitrage is switched, and in a 1031, I have to do equal or greater value, equal or greater debt, which can put me in a compromised position. And so you have debt flow that's out of whack. Maybe your cash flow maybe is not working as well because their debt is higher, but you did it because of the capital gains tax. And so talk to us a little bit about the frustrations when it comes to the 1031 exchange and how it's not ideal for these three, areas of investing.
Yeah, so well, there's a lot of restrictions on a 1031 tax exchange. One is you have to identify the properties within 45 days, and then you've got 6 months to basically clear the deal to make sure that it closes. And I've lost out on a couple 1031s because we identified some properties and then something happened and we weren't able to close them. I prefer to do. I'm a bigger fan of using cost segregation to decrease, to get the tax savings, and then we keep rolling it over. But basically, yeah, you've got to be able to balance those three, and it's tough. It's tough to find properties out there that do that. We look for a lot of older properties that we can do repairs on, to take a lot of capital or a lot of cost segregation depreciation up front on, so we mitigate a lot of those expenses and taxes.
Yeah, absolutely. If people want to learn more about an alternative to that, we call it the deferred sales trust. It can eliminate the need for the 1031 exchange, give you the opportunity to really practice what we're talking about, the pillars of a diversified real estate portfolio, which is time, liquidity, diversification, debt freedom, without having to be forced into another property. You can go to capitalgainstaxsolutions.com to learn more about that. And so it leads me to this next piece right here, because to us, the 1031 is the shotgun wedding, right? It's especially when the music stops. It's kind of like musical chairs. It happened in '08, right? It happened, but it took 3 years for the real estate market to go to the bottom, right? And mostly that was
Hmm.
residential houses, not as much commercial, but still the people who had too much debt, not enough liquidity or diversification, they lost half or all of their wealth in that time period because they were doing these 1031 exchanges and overpaying, taking on too much debt. And so we're seeing it happen now with people who've locked in debt that's not locked in long enough, right? It's shorter in nature. The rate cap has expired. The interest has jumped, and it's sinking the ship, right? The water is just flooding the ship, and they have to try to raise capital to bail out. They have to try to refinance and get longer term fixed debt just to see if they can sail and get some money out of it in a few years. And so the key here to me is having something that gives what every real estate entrepreneur wants, which is time, right? If time is on your side, but you don't have to rush anything or take on any debt that you don't want to take on, it changes the whole leverage on your side as the buyer versus it being in the 1031. And so here's some thoughts I have for you. So pillars of a diversified portfolio, I wrote down multiple tenants, right? So not just a single tenant, multiple tenants. And I would say number 2 would be multiple locations. Number 3 would be long-term fixed rate debt. Number 4 would be value add, being able to control your destiny. In other words, you're not just buying something that's completely turnkey and you overpaid for it. You bought it and you can do something to raise the rents, right? I'd also say the next part would be the capital gains tax exit planning. So you can get your powder dry on the sidelines, which means you don't have to be in real estate. Right. So I think the pillar of a
That's right.
diversified real estate portfolio is you don't have to be in real estate. You can actually keep your powder dry, or you can be in real estate in a way that's not direct ownership. You could be in lending to real estate. Right. And so the power of our strategy that we use, you can diversify your wealth and you can be a lender while everyone else is overpaying for the property. And then when the property values go down, you can be the buyer again. Right. And so you can get out of what I call a ownership hat. You could be a lender and go back to an owner, but you can do this in a tax-deferred manner. We call this the Netflix of building a real estate portfolio versus the old blockbuster method of just grinding through these 1031s, having a bunch of these single-family houses that is hard to consolidate in order to go to a bigger multifamily property. All of these different things that come into play. I think you've got to think on a three-dimensional way. Any thoughts on some of those pillars of the diversified real estate portfolio?
Yeah, it's evident that what people have been doing in the past is we're at a point in time where there has to be a change, and those ideas that you're talking about there are the ways that people can protect themselves when we're in a changing market, and we are definitely getting ready. I mean, we can feel the ground shift beneath us. Things are changing out there, so you're going to have to change your tactics. The old ways of doing something are not are not going to get you to where you want to be. So you have to learn new strategies and new ways to do things in order to grow your investment and then also protect it as well.
Absolutely. If people want to learn more about that, you can go to capitalgainstaxsolutions.com. You can also check out the best-selling book, Building a Capital Gains Tax Exit Plan, on Amazon. We have Kevin Harrington from Shark Tank in the book and a number of other really smart people that are talking. I got a couple of chapters, too, that I think you're going to enjoy. Basically, it's my story from 1031 exchange blockbuster to the deferred sales trust Netflix, right? Which is the secret that we use and execute on every single day. Works for businesses. It works for cryptocurrency stock. It works for primary homes. We can also save a failing 1031 exchange. Okay. And so you don't have to rush around without having a backup plan. Just go to capitalgainstaxsolutions.com or check out the book. All right. That being said, Mr. Sean, we're running out of time. Are you ready for the lightning round?
Yes, sir, I am.
All right, knowing what you know now, if you could go back to your 20-year-old self and you could sit down with the person that you most admire, what's the 1 or 2 gold nuggets they would tell you to help you save hundreds of hours and put thousands of dollars of more money in your pocket?
I would have gotten started. They would have told me to get started with real estate faster, but also pick the right partners. Pick the right partner. Your partner, your spouse, and the partners that you work with. They'll have the greatest amount of impact on your ideas and how you basically what happens in your life. Those people are very, very important. So make sure you pick the right people. If you don't pick the right people for that, it makes a huge difference.
Excellent. Question number 2, what are you most curious about right now?
Actually, I'm curious to see what's going to happen. We're with our world economics. We're seeing some crazy things happen, especially like in the Japanese market. There, some crazy things have just happened. So I'm curious to see what's getting ready to happen in the world economy.
I couldn't agree with you more, right? We have over $35 trillion of debt. And Biden's proposing to increase the capital gains tax rate from 20 to 44%, eliminate the stepped up basis, limit the 1031 exchange to basically $1 million per married couple. And, Bitcoin is, one of the close to all time high. It's around 65,000 as we're recording this. The world in multifamily units, we're 4 or 5 million units short for housing in America. I mean, there's just so many key facts that are just trains that are going in perhaps a direction that's going to crash together. I couldn't agree with you more. Next question: Number one leadership quote or theme that you strive to live by.
Well, I mean, I'm kind of old school, so the thing that I try and live by the most is the golden rule: try and treat people the way you want to be treated yourself.
Love it. Amen to that. Next question. Number one book you've recommended or gifted the most in the past year.
Well, I mean, there's the old standby of Rich Dad Poor Dad that I've given out a bunch of those. But basically, boy, I'm trying to think of. I've read so many books this year. I'm trying to think of one that's had the most amount of impact. Probably The One Thing by Milan.
Gary Keller.
Yes, I'm sorry, Gary Keller.
Yeah, The One Thing, Gary Keller. If you haven't got that book, get that book. And I'm going to reread the book because it's that good of a book. Excellent. Next question. The number one way you're using ChatGPT.
For a lot of our descriptions on our properties and stuff, we're using ChatGPT, and then also we run through all our correspondence through there to just kind of make sure that it sounds as professional as possible.
Excellent.
Like to use it for more. We just haven't gotten the best at it. We're still learning how to use it.
Yeah, you got to start somewhere, right? So,
yes.
And this is kind of wrapping up the last question, which is kind of the main thesis of the podcast, which is we believe that the key to scaling the business and compounding your wealth starts every day with a mindset of stewardship over ownership and applying billionaire principles. And so, for stewardship over ownership, A, what does that mean to you, Sean? And then B, how are you applying that to make a difference and an impact for something you really believe in?
Yeah, so we have started working with investors to apply their money to try and get them the best return as possible. And one of the things in stewardship, I put investors first because the way we're set up, if the investor wins, we win. So we always look out for our investors. That is the most important thing for us. Is that that whatever they invest with us, they're trusting us. That's their hard-earned money. We work very hard to make sure that our investors get the payoff that we're promising.
Awesome. Hey, Sean, thanks for being on the podcast, sharing your wisdom with us about the marketplace. Yeah, your unique background in IT and multifamily and owning yourself, I think brings tremendous value to the Empire Builders Capital that you're working with and the groups you're working with. For our listeners who want to get in touch with you, could you remind them one last time, what's the best place for them to find you?
Yeah, my email address, well, actually, if they just reach out to me through our website, empirebuildercapital.com, there'll be a section in there where they can get a hold of myself and my partners on there. My partners on there as well are very good people to know, and we all like to help people.
Perfect. Thank you, Sean. I also want to thank our listeners for listening to another episode of the Build to Billions podcast. Again, we believe that many entrepreneurs, investors, we want to be able to bring value to you on your journey from millions to billion. And the best way to do that is by listening and growing and gleaning wisdom from people like Sean, and also having a mindset of stewardship over ownership. So we're going to encourage you to practice that today and apply billionaire principles to scale your wealth, compound your wealth, and give more, all of it away for maximum impact. For those who want to take the next steps and learn a little bit more about how to build a capital gains tax exit plan, we touched about it today. You can go to capitalgainstaxsolutions.com. You can check out the best-selling book, Building a Capital Gains Tax Exit Plan. You can also go to our YouTube channel, Build It to Billions YouTube channel, as well as the Capital Gains Tax Solutions YouTube channel. We appreciate everyone out there, and we will talk to you again all real soon. Bye now.
Thank you.
All right, Sean, that you're my...